Hey everyone, welcome back to Corporate Decoder. Today VRTS just filed their quarterly report and I am seeing a big shift in their debt and acquisition strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is making some bold moves with a major acquisition, but it is significantly increasing their debt load, which is something to watch. Virtus Investment Partners, Inc. is a financial services company, and they've just released their latest quarterly report. This filing gives us a peek into how they've been doing in the second quarter of 2026. Let's dive into the numbers. Looking at their balance sheet, things have changed quite a bit since the end of 2025. Their cash and cash equivalents have dropped significantly down from over $386 million to around $176 million. This is a big decrease, and it signals that they've been using their cash for something. What has really jumped out is the massive increase in intangible assets and goodwill. Intangible assets are up from about $327 million to almost $600 million, and goodwill has ballooned from around $397 million to over $640 million. This points to a significant acquisition. Indeed, a quick scroll through the notes confirms a major acquisition. They bought 56% of Keystone National Group, LLC on the 1st of March. 2026, this acquisition cost them a hefty $308.2 million, with a significant portion paid in cash and the rest in contingent considerations, which are essentially future payments based on performance. This is a big strategic bet for Virtus, aiming to expand into private markets with asset-centric private credit. This acquisition also heavily impacts their liabilities. Contingent consideration, which is money they might have to pay out later based on how well Keystone performs, has shot up from about $39 million to over $122 million. This shows the scale of the performance-based payments tied to this deal. Another big change is the jump in investment manager non-controlling interest liability from around $15 million to over $152 million. This reflects the new ownership structure and how outside investors' stakes in their managed entities are now accounted for. Their debt has also increased, moving from about $390 million to over $418 million. While not the most dramatic change, it adds to the overall financial picture after the acquisition. Redeemable non-controlling interests, which represent stakes in their business that can be bought back, have also more than doubled, going from around $103 million to over $205 million. This often happens after acquisitions when new ownership structures are put in place. Now, let's look at how this acquisition and the market are affecting their revenues and profits. Total revenues for the second quarter of 2026 were about $201.4 million, a decrease from roughly $210.5 million in the same period last year. This dip in revenue is mainly due to lower average assets under management, meaning the total value of the investments they manage has decreased. Investment management fees, which are their primary source of income, saw a decline. They brought in about $170.9 million in the second quarter of 2026, down from $179.5 million in the prior year. This is a direct result of managing fewer assets. The impact on operating income is quite noticeable. It dropped from about $45.2 million in the second quarter of 2025 to $27.3 million in the second quarter of 2026. That is a nearly 40% drop, showing that the increased costs associated with the acquisition are weighing on their profitability. A big reason for this operating income drop is a significant increase in amortization expense, which has jumped from about $12.9 million to over $20 million. This is primarily due to the amortization of the newly acquired intangible assets from the Keystone deal. Think of it like spreading the cost of those acquired assets over time. Despite the revenue dip and increased operating costs, net income attributable to Virtus shareholders actually saw a slight increase, up from about $42.4 million to $45.3 million for the quarter. This is a bit of a mixed signal, suggesting that while the core business is under pressure, other factors might be helping the bottom line. Diluted earnings per S-share, a key measure of profitability, increased to $6.68 from $6.12 in the prior year. This is a positive sign for shareholders, even with the operational challenges. Let's look at their assets under management, or ARMAT. The end of June 2026, their total ARM was about $152.2 billion. This is down from about $170.7 billion a year ago, a drop of nearly 11%. This decline is due to net outflows, meaning more money left their funds than came in, partially offset by positive market performance, and of course, the addition of Keystone. Retail separate accounts saw a significant decrease in ARM, down almost 24%. This could be a segment they are re-evaluating, or one that is particularly sensitive to market conditions. Open-end funds, which include their US retail funds and ETFs, also saw a drop in ARM of about 6.4%. This is their largest segment, so any decrease here has a substantial impact. Looking at asset classes, equity, which is usually a big driver, has seen a significant drop in ARM of over 28%. This suggests investors might be moving away from equities, or the market performance in that sector has been weak. Fixed income, on the other hand, has seen a modest increase in ARM, and the alternatives category, which includes things like private markets and hedge funds, has seen strong growth of over 36%. This aligns with their acquisition strategy, focusing on areas like private credit. The average fee earned expressed in basis points has actually increased slightly across all products. This is interesting because even though their total assets under management are down, they are earning a slightly higher percentage on the assets they do manage. This is likely due to the higher fee structure of the newly acquired Keystone business, which specializes in private credit. Interestingly, they've incurred restructuring expenses of about $0.8 million in the second quarter and $3.7 million over the first 6 months of 2026. This often indicates internal changes or integration costs following the acquisition. When we look at cash flow, the investing activities section is dominated by that Keystone acquisition. Cash used in investing activities surged to nearly $200 million for the first 6 months of 2026 compared to just about $4 million in the same period last year. That is the direct outflow for the acquisition. Financing activities show a decrease in cash used, down from over $226 million to about $84 million. This is largely because they've increased their borrowing, with net borrowings up significantly by both the company and its consolidated investment products. This means they are leveraging debt to manage their cash flow and fund their growth initiatives. Their credit agreement provides for a $400 million term loan and a $250 million revolving credit facility. At the end of June 2026, they had about $397 million outstanding on the term loan and $30 million on the revolving facility. This shows they are utilizing their available credit lines. Looking at their overall liquidity, cash and cash equivalents have significantly decreased, as we saw on the balance sheet. This lower cash position, combined with increased debt and contingent liabilities, means they are operating with less financial cushion than before the acquisition. The net flows for their open-end funds show consistent outflows, meaning investors are pulling money out more than they are putting in. This is a trend across the industry, but it is still a challenge for asset managers like VRTS. Other income and expense, net, swung from a slight expense of almost $100,000 last year to a significant gain of over $18 million this quarter. This is largely driven by a big increase in realized and unrealized gains on their own investments and a positive swing in gains from their consolidated investment products, or CIPs. This means their personal investment portfolio performed well, somewhat offsetting the challenges in fee generation. In their management discussion, they highlight the revenue decrease and the impact of increased amortization expenses. They are clearly navigating the post-acquisition integration while dealing with market headwinds that are affecting asset flows. So, what is the big picture here? VRTS Investment Partners is making a significant strategic push into private markets with the acquisition of Keystone. This is a bold move that could pay off in the long run by diversifying their offerings and tapping into higher fee structures. However, it comes at a cost, a substantial increase in debt and contingent liabilities. A drop in overall assets under management and pressure on operating income due to increased amortization. The slight increase in net income and EPs is somewhat encouraging, likely driven by their own investment performance and the higher fee potential of the acquired business, but it masks the underlying challenges in asset gathering. The risk I am watching is whether they can successfully integrate Keystone and grow its assets under management to justify the acquisition cost and debt burden, especially with ongoing outflows in other parts of their business. My biggest concern is the increased leverage and contingent liabilities in a potentially volatile market. What I'm actually looking for is a sustained increase in net flows and ARM in the acquired segments to offset the revenue pressure elsewhere. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord linked in the description.